What about GDP? So gross domestic product, that is the total output in a single year. And I think in 2024, we were at 1.3%, and we're expecting 2% this year in 2025.
The 1.3% is anemic.
Yeah, it's not much.
It's growth, but it's not really growth. It's less than the inflation rate, for example. So you almost, you want to see your GDP growth to be above your inflation rate to have real growth, if that makes sense, because otherwise when you discount it for the cost of everything moving higher, it's not really there.
Yeah.
At the same time, if you look at China has slowed down, but it's still got economic growth beginning with a 5, which is phenomenal. China's a different kettle of fish.
It's a beast.
We need to see stronger GDP growth than that to be able to boast that we're in a strong financial position. Anything under about 1.8%, I would suggest is not recessionary, but it's very, very close to that. It's not even soft landing territory. It's too low for it to be soft landing. Hey guys, welcome to this week's Money and Investing Show. This is a big episode. We're looking at the Australian economy. Are we heading for a recession or are we heading for a soft landing? A lot of economics to cover in here. Don't be turned off by that. Roll the sleeves up, absorb the information we're about to share, and you'll understand how the tapestry of economics comes together in order to form a view. Lots of things to take out of this. I know you're going to gain a lot from it, and I look forward to hosting you on the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. I'm well. Thank you very much. Now, we're going to get local today in this podcast. I'm quite excited because I want to ask you a question. Is Australia heading into a recession or better yet, a soft landing? Let's break down the stats and get to a conclusion.
An interesting one, isn't it? And look, there have been so many big issues floating around in the ether. We've just had an election. We've just gone through Liberation Day and the tariffs around that. So a lot of uncertainty out there. And a lot of those things can, of course, rub off on where the economy is going, which in turn rubs off on the well-being of all of us, both financially and mentally, I suppose.
That's right. Let's talk about those two items to begin with, set the context, then we'll talk about some numbers. So the election, first and foremost, we had a Labor win. In your opinion, without getting too political on this, what kind of economic impacts do we think it'll have?
I think looking on the positive side of the ledger, you've got someone that's got a majority government, which I think when you govern with a minority government, which is what we've seen over the previous number of years, you've had a situation where you've had to placate other parties that are minor parties, specifically in this instance, the Greens, whereby you've had to indulge some of the policies that they've wanted to put forward in order to get their support across the floor in Parliament. And trying to govern by minority is pretty hard because you end up pleasing nobody. I think, it's a very clear mandate that the Albanese team have to do what they need to do with the result that they got. And I hope it provides a little bit more structure and perhaps a movement, perhaps a little bit more towards the middle of the road.
Yeah, and there's been, some talk of some interesting tax reforms, particularly around super. Yeah. Then there's also been some reprieve for people with student debt, as just purely as an example, 20% discount as of June 1st, I believe it is. Yeah. So there's a bit of a mixed bag in there.
Yeah, look, I mean, it's a Labor government, so it's going to be Robin Hood, which is, without casting aspersions, is typically what you see from a Labor government, whether that be here or in the UK, where if you're above the line in terms of wealth, then you're probably going to get clobbered in some way, shape or form in order to fund policies that are at the other side of the ledger for people that in some instances are at a disadvantage. I'm not sure that people with student loans are at a disadvantage because they've borrowed the money to get a higher education to hopefully get a better quality job, which means they pay more and they pay more tax down the line. So quite why the subsidy there is, I'm not sure, but that's obviously a popular policy amongst the supporter base.
100%. So without, and I can see the steam coming out your ears.
No, I'm under control. You're under control. Smoke or steam here. Like I say, I'm pleased to see a majority government, and I think that's irrespective of outcome. It just makes things a little more sensible.
Yep. So Labor win, majority government. On the other side of the coin, over in the US, we've got this, the Liberation Day that's just happened, and now we're starting to see countries come to the table and negotiate with POTUS.
Yeah, look, it's an interesting one. My father-in-law and I have a very good-natured spar from time to time. We're on the same page with many things. He's not the biggest fan of number 47 president in the US, we were having quite a good involved conversation over quite a nice bottle of wine actually yesterday, thinking about it. it was like, why would you do all of this? And I guess the conclusion, and this was evidenced, I think, in President Trump's 45th term, is that if you appear to be irrational and out of control, it creates a level of uncertainty where people can be, I'm going to use the word fearful. And as a consequence, there's a level of respect that comes from that fear. And I think a lot of this, and don't get me wrong, I personally believe it's been handled and communicated not in the best way. It's been quite ham-fisted in the way it's been done. But the outcome, which we're starting to see filter through, is largely what the game plan was, to have more favorable terms of trade with countries where the US has had unfavorable terms of trade for quite some period of time. So are we looking at the outcome from this or the methodology to get there? and I think when it comes to President Trump, because he's such a controversial person, and because you do, without question, have a media bias that is very anti, whatever he does is going to come in for more scrutiny. I think we've got to pay attention to the fact that markets have recovered. We're in a situation now where China, to an extent, has lost a little bit of the whip hand in world trade. And I think there's something of a temporary thing, because remember, the US political cycle is 4 years. In China, they're 100-year dynasties. So they're playing the long game, and they'll outweigh the US, and ultimately, long term, will probably come out on top. But for the moment, it's sort of stabilized things a little bit from what I can see. And with the volume of countries that are arriving at trade deals with the US now, it seems to have done its job for the moment. I think personally, and for most investors, is probably an experience you'd probably choose not to sit there looking at on the screen and feeling the pain, but it was only painful if you exited.
That's right. And it's been pretty much a V-shaped recovery since then.
Certainly has.
The UK signed a deal, China signed a deal, at least for now. More locally, though, here in Australia, without wishing to date this podcast, no deal signed as of yet officially. As such, let's talk about some of the economic impacts of all of these factors as we stand right now.
We're in a very difficult position as a country, because our main trade partner is on one side of the ledger, and our main security partner, and I guess to an extent, our cultural partner, is the US. And so we're kind of sort of sitting in between these two juggernauts as they're slugging it out, and we stand to not be in the best position unless we can negotiate some reasonably favorable terms. And the challenge, I guess, we have from a diplomatic perspective is that, I've mentioned it previously, we've got an ambassador that's not spoken of President Trump in the most glowing terms. I think referring to the most powerful person on the planet as the village idiot
it's a tough sell, unfortunately.
Is a pretty naive thing to say, and it probably confirms that the person making that statement probably is what they said the other person is, as opposed to the other. But again, we'll park that one for a moment. Where we can really do well here is a more structural review of Australia in itself, where, sure, we need exports and we export to a lot of countries, but the terms of those exports aren't great. We look at our energy policy, for example, where we export natural gas at price A and then re-import it at a higher price B. Makes no sense to most people. As an economist and as someone, I'd say, without putting tickets on myself, is above average intelligence, I can't get my head around why we would do such a thing. So if we reshape the way that we look at our export markets too, it's a good opportunity for us. And we provide so many different things insofar as, from a fossil fuel perspective, we're one of the world's largest coal exporters, and it is our second most significant export. And maybe going through the election cycle as we have, and seeing the Greens no longer in a position to negatively impact on, for example, coal exports or agitate that space, it may leave that pathway back open for us. And trust me, there is plenty of demand for coal out there. When you look at the volume of coal-fired power stations being built in Indonesia, India, China, to give you three examples of countries that are building hundreds of them, steel production and so on. Our iron ore relationship with China's economy has slowed down. It's still growing at 5% and a bit, so it's still growing handsomely, particularly compared to the Australian economy, for sure. Where we're running into problems is, for example, with beef, where we are now in a situation where, because we don't import American beef, they're slapping a ban on us exporting Australian beef. And like I say this firsthand with friends, family, and family interest in itself within the beef production type of thing, are clients as well in that space. We have such a tip-top, high-end, high-quality product that almost should be dominating the world in terms of the quality of the export we have. Similarly, with our sheep industry too, and those live export bans have made it very, very difficult for our farmers. And Australia could be the garden bowl of the world in terms of food exports. You know, if we, for example, were able to use desalination to rehydrate the Murray-Darling, Murray River complex and Darling Basin, all of those different places. We keep growing food coming out of our ears and export with everybody, but we're not doing that yet. Maybe we need to move to that. But these are all things that weigh on our economy and put us in a situation where there's a level of uncertainty. And that, I guess, is the question at hand. Very long-winded ramble to get there. Are we heading for a soft landing, or are we heading for a recession? And the decisions that the new government get to make will have a direct and immediate impact on whether it is a soft landing. And the soft landing is just, instead of going through this nasty correction within the economy where you see unemployment spike up and the misery index increase, you've got a situation where things may slow a little and then kick out the other side and become more sustained and more positive again. And that will come down to where a government policy sits over the next 4 years.
Absolutely. Let's dive into it in that instance. Let's kick off with unemployment. That's in my mind, the big ticket item. Yep. Now, unemployment is about 4.1% at the moment in Australia, which is pretty much full employment.
That's right. I mean, we're in a situation that's been reasonably stable for quite some time now. And perhaps is the rationale for a migration policy where we need more people in the workforce. I'd like to see more people engaged in the workforce if we could, and 4.1% is largely deemed as being full employment. But I think a lot of people that aren't counted in those statistics because they're not seeking work anymore, and they've kind of opted out. You've had that quiet quitting movement, for example. You've had an aging population where people have maybe taken early retirement, and also you've got people that are just on the other side of the ledger, either because of medical benefits or other welfare that have left them in a position where, I'm not really that keen on being in the workforce.
Yep. At least with full employment, you can't have a recession. And as we know, one of the main tickers for a recession is high unemployment, which we don't have.
Yep. Look, that's true. I think what we need to see, given the one headline being the unemployment number, that's kind of like deciding what outfit to put on before you go outside. You might look and see what the temperature is, which is one measure. But you probably want to see whether it's raining or not too, because it could be warm and humid and raining, or it could be dry. It's going to determine what you wear. And I think in the same vein, if we look at the employment market, a 4.1% unemployment rate, which is largely full unemployment, where do you get the growth within your economy? Do you need more people? Or one of my pet peeves or areas to focus on is productivity of the people that you have working. And I think Australia over recent years has gone through a slump in productivity where you've got wage growth, where people are demanding higher levels of wages in order to keep up with the cost of living, which we've obviously been belted with in the post-COVID and Suez Canal supply chain issues and so on and so forth. So we've got a high cost of living to deal with.
3.4% too, by the way, to add into that for wage growth at the moment per annum.
Yeah. So, you're in a situation there where you've got, reasonably strong wage growth. And when you dive a bit deeper, and this is the interesting thing, one of the mandates, without returning to politics too much, is that, the government were talking about the creation of all these jobs, yet 70% of them were in the public sector. So they're not really jobs, they're government jobs. So there's a distinction between the private and public sector. Private sector typically is about productivity and productivity increase, public sector less so. And where we've seen the strongest wage growth is in the public sector. So not only have you got more jobs, but you've got wage growth sitting at about 3.6%, which is higher than the 3.4% average that you're seeing across the industry in itself. So you're increasing the people working in the public sector, which in my mind, as a pure dyed-in-the-wool capitalist, is the taking side of the ledger. And look, that's an unfair thing to say because there are people that are major contributors to the social fabric of society: police, ambulance, fire service, doctors, nurses, teachers, all of those sorts of people that are hugely important in there. But also you see this rise in bureaucracy as well in terms of some of the government institutions and the salaries that are going out there. So it's a question of kind of keeping that in check versus the private sector. But when you look at the private sector in itself, productivity growth genuinely isn't there, where we've seen quite the slump if you look over the last, say, 5 or 8 years, where the and it's a very difficult measure to describe to people. It's like, okay, you've got a job, but how productive are you within that job? And it's not growing enough, because I guess in the economics model, if you're going to be paid more, you have to be more productive to justify the pay rise. The money has to come from somewhere. It's not free money. That only happens on the public sector side of things. Okay, so in the private sector, to pay someone more, there has to be a productivity jump to justify that ability, and it's simply not there. And I had a first-hand experience of this, and I've been sitting on this for probably about 2 months.
Oh no, this has been stewing.
Looking for somewhere to weave in this particular anecdote.
Let's hear it.
So I want to compare two scenarios. Last year, my family and I were in Sicily, and we found this terrific breakfast cafe in Palermo, and there's one guy working there. He's doing coffees, and look, if you've spent time in Italy, and I know you haven't, you'll be spending some time there in a few weeks' time.
That's right.
Which I will be too. I think we're overlapping again. Breakfast in Italy often is just like a donut or something, or a pastry on the fly, sweet or savory, and a coffee. Again, press the bar, have your coffee, in, out, done. And so in this particular cafe, as I said, this is in Palermo, and there's one person who's serving the coffees, serving all the pastries, making sure all the coffee cups were in the dishwasher being washed, and taking the orders and payment for all this one person. Okay.
Sounds fairly productive.
And you'd argue that on a productivity scale, I'm sort of looking at this on holiday. I can't turn
10 out of 10.
I can't turn off. Emma's looking at me going, my wife's looking at me, Emma, she's like, what are you thinking about right now? So I'm just watching our friend over here who is like actually grinding pretty hard.
Killing it, yeah.
And probably, wages are fairly low in Sicily, so probably 9-10 euros an hour. Now, to contrast that to the entitled nature of our workforce, where we're not necessarily seeing productivity growth, but we're seeing a demand for high wages. One of my local cafes, there's a new barista, and this cafe used to walk up to the counter. The barista would take your order, you'd hit your card, and if you're paying with cash, you had to go to the cafe. But if you're just paying with a card, they'd take your order, make your coffee off you. Really good and great coffee, and very, very happy for quite a number of years. And different management structure now, and the barista's like, I can't take orders anymore, I only make coffees, so you got to go and order inside. So there are 2 people inside waiting for you to go in and take your order, and he stood there waiting for the order to come through on the FBOS so he can make it. And I'm looking around, there's maybe 4 people in this cafe, and he stood there going, literally twiddling his thumbs, waiting for the ticket to come through that's been processed inside. And and particularly in the sort of Byron area where I'm a barista, is probably $35-40 an hour. And you're going like, okay, where is the productivity growth there? That's actually a regression, because you've gone from someone that was taking the money and making the coffee, and there's probably somebody else going around to clear the plates up afterwards, to one person not making coffee, waiting for an order to come in, yet on a higher rate. And that's our problem within our economy, is that we have to, I guess, educate our workforce that a rising tide lifts all ships. If business is good, we all get good pay rises, but you can't just simply expect a pay rise because the cost of living is higher. It doesn't work that way. Seems to, but it just doesn't work that way if you want to have an enduring, growing economy that avoids a recession. So that's one of my risks, I think, for us hitting a recession versus a soft landing. You quite rightly say, from an economics perspective, gee, I'm off the weave. We're back where we need to be.
We're back.
But that's just anecdotal, watching things in life, right? So to have a recession, you can't have a full
You've got to have high unemployment, right?
But if you've got everyone working, but they're only working at, let's just pick an arbitrary number, 60% of capacity, isn't that the same thing as having unemployment?
Yeah, you're almost better off having people unemployed looking for other jobs than doing jobs that they shouldn't be in, right?
Or not fulfilling the potential capacity that they should be in there because it's in cruise mode, or worse, it's just not as productive as it could and should be. And look, again, without casting aspersions on local councils, we've got a roundabout that's taken the council 4 years to build. Singapore would have built an airport in that time, and they're still messing around trying to put a roundabout in. So, the productivity, it's just not there. And that's probably my biggest single risk.
That's the risk.
Yeah.
Okay, so we've got, really low unemployment, which is great. Wage growth questionable and productivity questionable.
Well, the wage growth is solid, 3.4%, when we've got inflation at 2.4% currently.
I guess you're outpacing, right?
Well, you're outpacing inflation. Yep. And again, I go back to my argument that if you've got wage growth that's above inflation, that's a reward for doing a good job and working hard. But when you don't have productivity growth, in fact, if you've got productivity growth going the other way, you're paying people more to do less. That's not economic growth.
Yep. Speaking of economic growth, what about GDP? So gross domestic product, that is the total output in a single year. And I think in 2024, we were at 1.3%, and we're expecting 2% this year in 2025.
The 1.3% is anemic.
Yeah, it's not much.
It's growth, but it's not really growth. It's less than the inflation rate, for example. So you almost, you want to see your GDP growth to be above your inflation rate to have real growth, if that makes sense, because otherwise when you discount it for the cost of everything moving higher, it's not really there.
Yeah.
At the same time, if you look at China has slowed down, but it's still got economic growth beginning with a 5, and which is phenomenal. China's a different kettle of fish.
It's a beast.
We need to see stronger GDP growth than that to be able to boast that we're in a strong financial position. Anything under about 1.8%, I would suggest is not recessionary, but it's very, very close to that. It's not even soft landing territory. It's too low for it to be soft landing. So where does that growth come from? And that again will come down to some big drivers from the election and where government policy sits. If we see more houses being built, which has been the perennial question. There's no houses in Australia for people. We've got a chronic shortage. If we were to get ourselves organised and be able to build more, that is a great way of increasing GDP, because not only does it employ people, it naturally lifts wages because there's commercial activity. Those people go and spend money at the dealership buying a new ute, who then goes to buy a coffee and a takeaway meal for dinner, and it expands. So it's that multiplier effect that we've talked of many times. We need to see things like that. We're not going to see a return of manufacturing to Australia, fully and simply because our labour costs are too high, and so too are our energy costs, which I guess leads into if we were to be able to strategically reduce our energy costs, the benefits for this are enormous. Number one, it's disinflationary. The biggest cost for people outside of food and their accommodation is energy, whether it's filling your car up with fuel or whether it's the electricity that you use at home. And the 150 from the government, non-means tested, was a great way to try and reduce inflation. But long term, we've got to look at our energy policies. And again, I talk about the removal of minority party interests from this election outcome. And if it means that we can have a focus on more traditional fossil-based energy to get energy prices lower, the effect of that means that it's disinflationary on our economy, which takes away a lot of the cost of living pressure on people. But with a lower cost of energy, it also will help boost GDP because it's easier for businesses to operate and grow on the back of that. So there's a double-edged sword on that. Lower energy costs are very, very good to boost GDP, but also it becomes disinflationary. So putting those two things together, I think, would be a huge thing if it's possible. And maybe without a minority government, that's something that can become a reality for us.
So what about if we factor interest rates into that conversation? Because at this stage, we're predicting interest rates to steadily come down.
Yeah.
We've already had one cut, and hopefully another one or two this year is what we're pricing in.
Yeah.
That should encourage spending and borrowing in the economy, right, to pick things up a little bit.
Lower interest rates always, effectively, the easiest way to conceptualize what a lower interest rate does is it allows more money to flow into the economy rather than it being taken out. So Economics 101, what's called monetary policy, interest rate management. If you put interest rates up, it encourages people to save because they're getting a bigger return on their money, but they also have to pay more money out in servicing debt. So it strips cash money that's being used in the economy out and is used to control inflation and get things under control. With inflation at 2.4% at the moment, which is, I don't know how real that number is, to be perfectly honest with you. When you look at the overarching cost of living in terms of what people are having to pay for different things out there and to get by, I don't know how accurate that 2.4% is, but let's just assume that it is.
I think we're the worst in the developed world in terms of cost of living.
Yeah. So, it's tough for people out there. Let's assume that 2.4 is real, though. The higher interest rates have sucked that money out of the economy, which reduces the amount of cash that's flowing around for people to be able to spend. If we get to a situation where interest rates start to be cut, it's likely to encourage people to spend more because they're debt servicing has become cheaper, and there's less incentive to save. So it's kind of like a current. It either flows that way or it flows this way, depending on where rates are. And there's a flexion point, the normalization point that sits in the middle. So if we see interest rates get cut, there's going to be more money flowing around the economy, which has the potential to be inflationary again. And the challenge that we have here for us here in Australia is because there's such a short supply of things, whether it be property or whether it's because the services that we operate with are so focused and concentrated. We've got 4 banks, we've got 2 supermarkets, we've got 1 airliner. So there's not a lot of competition to keep prices at naturally lower levels. And so Australia typically, because of that focused type economy, is likely to have an endemic level of non-price competitiveness. And I know there's a lot to unpack with this.
There's a lot going on here.
But likely to have higher inflation because of that. So if you put more money back in the economy, you run the risk of kickstarting inflation again. So I think the RBA, Michelle Bullock's got a really tight line to walk to very gradually back off interest rates, which, as someone that's a property investor, I'd love to see too, because that's good for the property market. But then you achieve the opposite of what a government outcome is, which is affordable housing if prices start moving up again. So these things are all woven together. Key thing, we've got to have more housing supply. That's going to go a long way to fixing that problem. So interest rates, I think we're going to see a cut, maybe 2 this year. And I guess the focus will be, what does that then look like at an inflationary level, particularly when you've got strong wage growth above inflation and you've got a fully employed economy to a large extent and lower interest rates. Usually that's a touch paper that you're lighting for maybe 18 months, 2 years down the line for inflationary problems again.
Okay. Any other stats we want to factor in? Maybe consumer confidence, retail sales? I mean, there's not a huge change in either of those 2 categories.
I mean, consumer confidence, like everybody around the world, got belted.
Through April, right?
April, because you had Liberation Day and it's like, heck, what does this mean?
Yeah. There's a lot going on.
Yeah, and I think the media have got a lot to answer for in that, as they do for a lot of things. All of a sudden there was doom and gloom and everything's going to be 5 times more expensive. I was chatting with one of my dear friends, Marco Molosini, who's an Italian friend of mine, who lives in a place called Cortona. Get to his wine.
I've heard about this place, actually.
If you can, great guy. And he's talking about the wine tariff that was going to go into the US. And it's 100%. That's going to be the end of the wine industry. Italy's the world's largest wine exporter. It's like, no. The alcohol tax is like 40 cents a bottle, and it's going to 80 cents on a $100 bottle of wine. But that's the perception that people then have.
Yeah.
So because everyone has this perception that the end of the world is nigh and tariffs are going to kill everybody economically and it's all a disaster, confidence fell through the floor in April in Australia. And that was also evident because we had an election then too. And we've talked about this many, many times. Economies, markets, they hate uncertainty. And so having a situation, we've got 2 major things. One, the Liberation Day tariffs, the other one being a federal election. Everyone's just gone, whoa, sat back on their wallet and literally just sat on that wallet. And that's where consumer confidence fell off a cliff. Now we've all had chance to digest it and the reality is kicking back in. That's picking itself back up off the canvas. And it hasn't replaced where it was post-April, but it's moving in the direction that it needs to. And you have to have a confident consumer that's comfortable to go out and spend, because the day they stop spending is when you start to have a major problem.
Yeah.
If you've got a situation where retail sales really slow down because people aren't confident, that's where you're going to start to see the specter of a recession rather than a soft landing kick in. So you've got to have people spend.
And retail sales recently too just came in below expectations. Yep. So not a huge drop, but
possibly a bit of a lag.
A little bit of
confidence too, maybe. I guess the reporting on that is maybe a little bit after the reality of what we've gone through in April. So it'll be interesting to see how that picks up going into the back end of the financial year, because you'd assume that people are going to potentially get a tax refund, which usually then flows through into retail sales to an extent, and you might see that come out the other side. So there are a lot of data points that are floating around that aren't universally on the green or the red side of the ledger. They're sort of in the middle at the moment, which makes it very, very hard to shape that view, recession or soft landing. I think a lot of it is going to come down to how the RBA handle interest rates and how they communicate that. It's also going to come down to where government policy sits. And I think if we're able to drive, and this is by no means following on the MAGA type platform in the US, but if we're able to drive energy prices lower everyone is a net beneficiary of that because it's effectively a tax cut to all people. You have to fill your car with fuel. You have the electricity at home. And if we can get that level down, it's disinflationary, which is good for everyone, but it also becomes good for our companies. They can become more productive and we get productivity growth. So that's a key point that I'm really looking for to see where we go with energy. And I truly hope that we do see energy prices come off.
All right. So critical point in the episode. Are we going to have a soft landing or a recession? What's your vote? We'll do one each.
Percentage or...
Just outright prediction.
Yeah, I'd say 60-40 soft landing over a recession.
Yeah, I'm leaning towards a soft landing too. I'm an eternal optimist, but the data at this point in time looks okay. Probably the biggest risk, as you say, is GDP is not super high and productivity is not that great.
We've got to see that productivity growth. Lower energy prices, productivity growth. And if you get good productivity growth, you can continue to have wage growth at a level that's commensurate. And that's the green shoots that you need for stronger consumer spending and a healthy environment that we can have and enjoy for business, for the economy across the board. 60-40 soft landing, recession, watch this space.
Yeah, I'll go 80-20, a little bit more optimistic.
And I appreciate that. And maybe the benefit of youth and less cynicism has probably urged you there. I'll nudge to 70-30.
Okay, there we go.
There we go, best and final.
Perfect.
And I think that's a realistic expectation. We don't know what is going to come out of this government yet in terms of hardcore policy. And the previous administration, we may as well finish on politics as we started. In their previous term, there was a lot of flip-flopping on representations that were made. If we see tax cuts made in the wrong way and in the wrong areas, we could see ourselves having a problem. If we see a truly Robin Hood approach by the government, there's a chance we could have a problem where, not necessarily over the next 2 years or so, but if we continue to stack out the public sector at the expense of the private, that in itself could be a problem. If we can get housing under control and if we can sort ourselves out in terms of our agricultural and energy policies, I think we're in territory where maybe 90-10 soft landing to recession risks sit there. But if we don't get that squared away and we see a resurgence of inflation because maybe there's cheap money or government subsidy flowing into the market and an RBA that cuts rates too quickly, which I don't think they're going to do, but there is a possibility, of course, then that might be something that kicks the ledger to the other side. Gee, there's a lot to unpack in that.
Oh, yeah, there's a lot.
As we're talking, I think like this is a lot of information.
It's a big episode.
And I guess we've got the ability and privilege of a lot of experience around markets. I'm an economist by qualification, I suppose, and I enjoy this subject matter, not macroeconomics, but how it all intertwines. And this is a hard one for our audience to unpack. I think the key thing is understanding that really the tapestry of the economy isn't one thing. It's so many things that come together. And it's in everyone's interest to have a healthy economy. That's what we all want to see. And hopefully with some great leadership out of Canberra that's not being pulled off its mandate, there's a chance that can happen. The risks, well, if we go down we look at tax changes on things like unrealized capital gains, that kind of Robin Hood policy is definitely not good for our economy, and it's the sort of thing that could see us set back 20, 30, 40 years. And
ouch.
And people, I was chatting with someone on the weekend on that, just to explain what I mean by a Robin Hood type policy. If you're a founder of a company and you own the shares, so if you were to take any of the tech businesses in the States and you've got billions of dollars of unrealized profit that you've made from the shares in the company, you pay tax on your income, on your dividends, but you don't pay tax on the capital gain because it hasn't been realized yet. And if you get into a situation where you start to tax unrealized gain, whether that be in the property space or whether it's on a stock portfolio, the person that's left with that tax liability, the person that owns it, has got to find ways of being able to find that cash. Now, if it's in a company, what you'll do is bring forward all your dividends to be able to pay the tax on your unrealized gain, which leaves less money in the company for it to grow and to invest in new things, which ultimately kills that golden goose. So I think that's a political minefield if we were to see a government move into that way of thinking, and that will be a classic Robin Hood policy. I don't think that's going to happen, but you've already seen some movement with asset sales in super in anticipation of trying to avoid some of the tax problems down the line. So I think prudent, non-Robin Hood type policy, and that'll be good for us as a country, and that's what I hope and pray we see.
All right, soft landing it is. Fingers crossed. Thank you very much, AB.
I'm moving to 90-10. Great chat. Thanks. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.